is part 2 of the mutual fund series, which I started last week. If you remember last week, I did a quick introduction to the mutual funds that's available on Saudi Tadawul stock exchange. There are close to 220 mutual funds that's listed on Tadawul across the different fund managers, across different asset classes, equity, real estate, debt, cash, etc. Right? And few locally based, few which is focused on GCC, few which are also international. So there's a wide variety of mutual fund options that is available. And I also went through how their performance has been, which sector they belong to, what's their growth strategy, what is the minimum subscription fees, et cetera, right? Today, I wanted to deep dive into a few of the equity-based mutual funds that's provided by SAB Invest. Because I have an account with SAB, I wanted to start with SAB Invest. But if you feel like the content is useful, I'm more than happy to also do this for other fund managers as well. So let's get started. The three main topics which I'll be covering today. Number one, list down the different SAB equity-based, growth-based mutual funds. Number two, define how do you evaluate these mutual funds. I start off with this in part one, but I wanted to provide you with a proper framework of technical and fundamental indicators that one should look into when selecting a mutual fund. And number three is once we have defined these criteria, we will evaluate them and rank the top few mutual funds from SAB Invest. First, let's go to the Tadawul Stock Exchange website, go to our markets, mutual funds, and then I will shortlist SAB Invest. I will go for equity. And for this scenario, I'll only pick the local Saudi Arabia and GCC based mutual funds. So there should be 13 in total. Yeah, so these are the 13 mutual funds by SAB Invest, which are equity based and which are based in Saudi Arabia or in GCC. So there are 3 GCC based funds, and the name itself will tell you this. So GCC equity fund, GCC equity income fund, and GCC equity fund. These are the 3. There will be few thematic funds as well here. So if I take the example of Saudi construction and cement companies equity fund, this is a sector based or one specific sector based, also known as the theme based, right? So sectoral / thematic based equity fund. Another example could be this Saudi industrial companies fund or the financial institutions equity fund, which will be purely focusing on the companies in that specific industry. So those are known as the sectoral funds, but the rest would be like active and large cap mutual funds, which we will be going through. All the data which I'm going to show in this video all comes from this website. So if for simplicity, let me show you where I was getting all the data from, right? So if I click here, and there will be a fact sheet which you can go through. This fact sheet will give you details about the historical performance, the subscription fees, the management expense ratio, what the latest portfolio has been, etc. You can also go to the financial statement to get more information about the fund manager, about the overall operating expense, etc. And the NAV details can be, you can get the NAV details from here as well, or else also from the previous table. Okay, so top 4 criteria for equity mutual fund. Number 1, fund manager and the capital house that's hosting it. In this example, it's SAB Invest. Second is the historical performance. Historical performances of a mutual fund does not guarantee the future returns, which is absolutely true. But at the same time, it's still important to look at how the fund has performed historically. Number 3 is the expenses. There are different sets of expenses that's considered when hosting or when creating a mutual fund. Right? We will go into some of them, and then some of the important technical parameters to consider. When we are investing in a mutual fund, we are trusting 2 sets of people. One is the capital house itself that's hosting the mutual fund, like the SAB Invest in this example, right? And second is the fund manager, who is shortlisting the stocks, doing the research about which one to keep, which one to drop, how much portion of money should be invested in each individual stock, etc. Right? So in terms of fund house, what we typically look into is the assets under management, so the AUM. If it's a big house or a small house, typically go for the medium to big house capital houses. SAB Invest, SNB, alrajhi, all these are big capital houses. They have more than 15, 20, 25 mutual funds. Each of them are really big. They have been running it for quite a long time. SAB Invest also has this component of SAB and Awwal Bank. SAB has an hsbc component, which is a huge long history. So all these are good factors to consider. Right? In terms of the fund manager, I do not have details about the fund manager who is owning the mutual fund. I could not find it, or maybe it's written in Arabic and I completely was not able to find it. So if anyone found the details, please do share it in the comments section. Right? Anyway, so for the fund manager, we look into how many years of experience do they have, their background, are they maintaining some other mutual funds as well? What is the performance of all the mutual funds, right?
if the person is, let's say, taking care of 5 mutual funds and only one of them is actually doing good in terms of returns, but the remaining 4 are like really, below the market index, that means that one was just a, luck factor, just, one of the outlier cases. So that's not a good indicator, right? So typically looking into his or her experience, the educational background, the other funds that they've managed, how many years have they been serving the same mutual fund. If it's someone who is very new, then expect a lot of portfolio turnover, right? There will be a lot of stock reshuffling. But the person has been here for a long time, that's a good indicator, and has been, doing well with his or her other funds. That's also a good indicator. So those are factors that it's more of a qualitative thing, an assessment that you have to go through by reading some of their reports. The third thing is the portfolio mix, and that's something that I want to deep dive in. The portfolio mix is about, what's the individual stocks that they've selected. Is it like concentrated into one specific sector, or is it a mix of sectors, right? So I wanted to show 2 examples, right? One from a thematic fund and one from a non-thematic, active fund, right? So number one is the Saudi Equity Income Fund, right? It's a Saudi Arabia focused active mutual fund. It's not a thematic fund. It's a growth based strategy, meaning that it's looking for growth stocks, not for dividend stocks alone. And the minimum subscription is 5,000 Riyal. That's one of the feedback I had for SAB Invest. All the mutual funds have a very, very, very high minimum subscription, which is for 5,000 Riyals, which is too much for, retail investors to even enter, right? I think it's a very bad decision from the side to have such a high criteria. Even last time when we were comparing with the alrajhi mutual funds, right? Alrajhi and SNB had a much significantly lower entry, which is a very good thing because that promotes more investments and opportunities, right? So it's again, if someone from the SAB Invest is listening to this video, or if you know someone from SAB Invest, please do share this with them that they should lower their minimum subscription. Anyway, so that's the general information. Now, if you look at the right side image, again, it's coming from the fact sheet based off Q2 2023. The top 10 holdings includes Alinma at 11% weightage, Al Rajhi Bank at 7%. Yeah, SABIC. Then you have Lijam Sports, Sahara International, etc. The top 10 is contributing to almost 60%, which is a good split. It means that there is a lot of, it's not focused on one single individual stock, which is good. Even if you look into the individual sectors allocation, banks are allocated 18%, consumer services is allocated 17%, transportation materials is 12%, transportation is 10%. So you can see like it's dependent on multiple industry sectors, and it's also not over dependent on one single sector, which is also a very good thing, right? So it's because it's not a thematic fund, right? So it will be split across this, and all the top 10 you see are all large cap companies that we have covered in our large cap, mid cap, small cap video, right? So this is a very good thing. It's a well distributed, not over dependent on any one individual stock, not over dependent on any one sector. That's good, and it's all large cap companies that you will go through. You can refer back to my large cap, mid cap, small cap video to understand how to get a rough estimate of which market cap does this stock fall into. Right? So if I show another example, it's the Saudi Industrial Companies Equity Fund, right? It's a thematic fund. Again, it also has a very high subscription of 5,000 Riyals. Now here, it's the top holding is Saudi Aramco at 16%, Al Marai at 8%, etc., etc. And therefore, the top 10 is almost close to 70%. And if you look into the sector distribution, materials is 38%, energy is 16%, capital goods is 17%. Capital goods will include your cables, your pipes, and all those industrial companies, right? So these 3 sectors heavily dependent on the energy, materials, mining, gas, etc. It's close to 72%, right? These 3 sectors itself. So if it's cyclical, you will see a cyclical performance also, which I'll show you very soon. So this is an example of if you are confident about this industry, if you're an expert in these industries, if you have some knowledge about these industries, and you have a rough estimate of how this industry has been growing, right? Maybe in the next 5 years you're expecting a boom in this industry, then maybe this is a good option for you to consider, right? So but if you are like a retail investor, like do not have much time to study these industries by themselves, or you don't have much idea about these industries by themselves, then you should go for a non-thematic, large cap based, preferably an index fund. But because there's not much index funds here, you only have the NT30 ETF, which also something I've covered, then you should go for the active large cap active equity funds. All right, so that's number one, which is your fund manager and capital house characteristics, right? Number two is historical performance. Again, as I mentioned earlier, past performances do not guarantee the future returns, which is absolutely true, and I live by it. But at the same time, you still want to look into how the mutual fund has lived the test of times. For example, was it just performing in 1 or 2 years out of the last 10 years, right? Or was it consistently giving you good returns? So the longer the better. So it has been running for a long time, and as stable the better, right? Because it has been consistently giving, not like consistently 5%, which is not possible, but at least like 3%, 4%, 2%, 7%, but somewhere around the 5% mark, versus something like minus 10%, 0%, plus 10%, 20%, minus 40%. So that's volatility, or that's the standard deviation that we will follow later, right? That's something not preferred. So here we were looking into three main things: the 3-year, 5-year, 10-year return, average return, the rolling return, and the individual performances of the years as well, right? So individually, how has this been performing over the last 5-10 years? Awesome. So the same fund, if we were to look into the individual performances, right? So on the left side, we have just shown like what has been the 5-year return. Average return has been around close to 15%. 10-year return has been close to 9%. And since inception, which has been somewhere close to 1995 that this mutual fund started, it has been close to 13%, right? So amazing return, like way above the inflation mark, way beating the the FD returns that the banks have been providing here. You can also see this because it's investing all the large caps. It has a good distribution amongst banks, amongst energy stocks, amongst consumer stocks. So that's a good indicator. And even if you look into the individual years, 2016, 2017 was very close to 3% and minus 3%, right? So one of those poor stocks. And then it has been pretty much decent, right? You got 2018 at close to 16%. Then you had somewhere close to 14%. Then you had in 2020, you had during the COVID year, you had somewhere close to 7-8%, still beating the FD returns. And then 2021 was like a super year. You will see like the spike across all the mutual funds, close to 24%. And then 2022 has been a sudden drop, close to 5%. I'm not saying that this is the perfect stable return option, but still gives you a view of the cyclicity in mutual fund returns. So let's say you were someone who saw the 24% return in 2021 and started your mutual funds in 2022. You need to go with these things can go up and down, right? And that's why mutual fund investing is purely a long-term game, right? You cannot time the markets, and therefore it's like considering you have like 10-15 years of horizon of investing, that's the best time. So another example is from the cement industry, another thematic fund that we had, right? There, the 5-year return was 11%. Then you had minus 1%, and since inception, it has been minus 2%. Those who know about construction cement, it's a highly cyclical industry, right? Years where it's like extremely good, depending on the kingdom's construction mega projects and all those, and then suddenly there will be fund issues, right? And you're not doing any constructions there, and therefore the demand is very low, and therefore the companies will perform very poorly. So it's a highly cycling, and if you look into the right side chart, you will see that cycle perfectly, right? So 2016, 2017, 2018 has been negatives, as low as minus 20% as well, right? And then suddenly 2019, you had like a super year of close to 60%, right? And then you drop down to around 20%, then you go to 2%, and then you go to minus 15%. So you see that cycle of where 2019, 2020 was comparatively better. There was a lot of kickoff of projects that came in. That's when the neom line project was launched. Same will be the case even with banking institutes. Banks will have comparatively larger cycle durations, like 5-7 years. I mean, it varies country to country, but what I've seen is it has a larger cycle duration as compared to infrastructure and cement industries. Number 3 is the expenses. So what is expenses, right? For you to understand that, you need to understand what's the process of hosting a mutual fund, right? So once a capital house like SAB Invest decides to create an NFO, a new fund offer for a mutual fund, and they launch the mutual fund, right? They have to staff first a management team, which is a mix of research analysts and experts who do like regular daily research on each individual stock, looking into their financial statements, etc. Then there's also fees for, like, let's say the auditing fees, the other operating expenses, like the cost of running the capital house, for the reports, for printing, etc., right? So there's a lot of small fees that you have apart from the operating expenses. So that's one, and you will see these reported as in terms of percentages, which is the the operating expense or the respective cost divided by the total assets valued under that fund, right? So that's how it will be expressed as a percentage of the total value or the total asset value of the fund, right? Apart from these, there's also fees, including for the subscription fee or the redemption fee. So when you are exiting, let's say, a mutual fund very soon, even before the minimum period, or let's say you want to redeem some amount, they also charge you. Some funds charge you, some funds do not. So all these gets calculated and comes under the expense ratio, which is something that you might have heard before, right? So expense ratio is basically what is the fees that you're paying for every money that you're investing. So let's say you have invested $10,000 US dollars in 1 year, right? And the expense ratio of that fund was 0.5%, which that means that you have spent $50 as expense. You have paid $50 to the mutual fund manager or to the mutual fund house for creating and for maintaining this mutual fund. So that's not part of your investment. That $50 has gone out of your 10,000 USD that you have invested, and that's every year spent, right? The expense ratio will be typically lower for a passive mutual fund because there is not much research involved. You're just imitating the index itself, right? So the expense ratio will be as low as 0.03, which is the lowest by Vanguard. But the active mutual funds, which is what almost all the mutual funds in Saudi Arabia are, there the expense ratio would be somewhere close to 0.5% or 1%, or even as high as 1.5% that some of them I've seen, right? So that's what. And then separately, you will also have the redemption fees and the subscription fees, which is not part of your expense ratio. That's separate fees that you have to pay, because those are like one-time fees. Expense ratio is more of an indicator of the operating cost, which is like repetitive every year that you have to pay for your investments. The subscription fee and redemption fee is a one-time effort that you have to pay, when you're subscribing or when you're redeeming it. So people will say that lower the better, right? So if your expense ratio is the lowest, just go blindly and select that mutual fund. I will not agree to that, because let's say you have two mutual funds, fund A and B, right? And fund A had a historical return of, let's say, 20%, and fund B had a historical return of just 5%. And your expense ratio for fund A was 1%, but your expense ratio for fund B was 0.05%. So you'll see that, okay, fund B has, just a very low expense ratio, and therefore just go for it. But historically, the returns have also been very low. So you have to look into the net effect, right? Net return, which will be your actual return considering your expense ratio, and then maybe fund A looks better because it has been giving a much higher consistent returns, and therefore paying that 1% is fine for me, right? That requires some extra efforts, which is why they're charging that 1% expense ratio, right? You have to look into the overall. But amongst all the passive funds, I have two passive funds which is purely back in India, which is purely based on the expense ratio, because passive funds typically have almost the same stocks, right? You're imitating the index, means that you have the same portfolio, and therefore if you are charging me low, I will go with that. But with active funds, you have to be a bit more creative in assessing that. So here I have just put a screenshot of the 13 mutual funds and just put like what the expense ratio, management fees, minimum subscription fees, minimum redemption fees, custodian fees, all those details have been here. You will find this on the website as I showed you earlier, right? So you will get a sense that the expense ratio has been close to around 0.6% for the SAB Invest mutual funds, right? And the subscription fees, as I was saying earlier, is 5,000 riyals, very high. Management fees is close to 1.9, 1.7%. You also have a minimum redemption of 2,000 or 2,500, right? Redemption fees is almost zero, negligible, right? Which is good. Subscription fees is low, but still it is there, 0.02%, right? So when you're investing 5,000, 0.02% of 5,000 is what a subscription fee is going as, right? Then you have the custodian fees, etc. So technical parameters is more about how the fund has been performing against the benchmark. So you need to understand this, that every mutual fund, when it's created, there's a benchmark associated to that mutual fund. So even if it's a large cap stock, right, investing in all the large cap companies, you will have a benchmark index that it's always tracking against, right? To assess whether it's performing better than the index and how much better than the index, etc., etc. And the technical parameters are coming from that comparison, right? Just a fact, at least in India, in US, almost 85% of the active mutual funds, they do not beat the benchmark index. Okay. So that's why everyone says that passive investing is the best investing for long term. right? Because there's no point of paying all these high fees and hardly fund managers beating their indexes, right? So, and unfortunately in Saudi Arabia, we do not have a lot of passive fund options. The four technical parameters, important parameters that comes under this is the Sharpe ratio, the beta parameter, the alpha parameter, and the standard deviation. So the beta of a mutual fund is a measure of the relative risk, right, which is expressed as a number or as a fraction. And it can take any value between less than 0 or above 0. So it's minus infinity plus infinity. It can take any value. It gives us a perspective of the relative risk of the mutual fund versus the benchmark that it's based on. So let's say if the beta of a mutual fund is less than 1, this means that the mutual fund is less risky as compared to its benchmark. Now, if the beta of the mutual fund is equal to 1, means that it's as risky as the benchmark. If the beta of the mutual fund is, let's say, greater than 1, which this means that it is riskier than the benchmark. So in a way, it's not telling me the risk factor of the mutual fund. It's just telling me the relative risk of the mutual fund versus the benchmark. But it's a good indicator. So lower the better, right? So beta being close to 1 or lower than 1, it's good, provided that the benchmark itself is not like super volatile. Second is the alpha. Alpha is defined as the excess return of the mutual fund over the benchmark return, however, on a risk-adjusted basis. So what is a risk-free investment in any given economy, right? A risk-free where there is super guarantee that there is no interest risk, there's no credit risk, right? And there's no return risk, right? So, and the perfect example of this will be a treasury bill, right? Which has the sovereignty, it's guaranteed by the government or guaranteed by the kingdom. I don't know whether we have treasury bills in Saudi Arabia, something that I have to check myself. But whatever is the sovereign guaranteed fund, right? That's the risk-free that we consider as the risk-free. So alpha gives me a factor of how much is the mutual fund providing me extra than the benchmark return, but on a risk-adjusted basis. So comparing to a risk-free return, right? So the exact math, etc. If you're interested, I can share that in a separate video. There's also like lots of existing YouTube videos and blogs that talks about alpha, beta, the math behind it, how it is calculated, etc. So if you're still interested for me to cover, I'm happy to cover in a separate video, right? Basically, it's good to have like a high alpha. Standard deviation, most of us might be aware of this. It's more to do with the the volatility. So higher standard deviation means it's more volatile in terms of the performance, right? So let's say I'm taking two examples, right? So there's mutual fund A, which the year to year performance or the returns of this has been 5%, 15%, 5%, 15%, 5%, 15%. So if I take the average of the last 6 years, it has been 10%, right? Now mutual fund B is where the return has been 9%, 11%, 9%, 11%, 9%, 11%. So here again, the mutual fund average should be close to 10. But here the standard deviation is lower because it has been less volatile, right? It has been very close to that 10. So it's more predictive and it's less volatile as compared to the previous fund, which had the same return, overall returns, but it was more volatile. So this is a factor. Standard deviation gives me a factor of, how volatile the mutual fund is. Typically, mid cap and small cap stocks will be, or small cap stocks or funds will be more volatile as compared to the large cap mutual funds. So lower the better in terms of the standard deviation as well, right? Now the fourth ratio, and the most important of all these, is the Sharpe ratio, right? So let's, again, to explain this, let me assume that there are two mutual funds, A and B, right? The overall return of both the funds has been 10% and 12%. So if I ask you like which fund is the best of these two funds, you will say that fund B is the better because it has been giving a higher return than this. Now let me also factor in the risk associated. Let's say the risk associated to each of these funds is 20% and 25%. Okay. Now, if I ask you like which of these is the better fund, now it will become a bit complex, right? It's not very clear that the risk is 5% higher for fund B, but the return has also been 2% higher. So if we do like some kind of a weighted average or weighted fact analysis, does it still mean it's better? Fund B is better than fund A? We don't know, and that's where Sharpe ratio, or it's a direct formula that gives me a value considering the risk factor and the risk-free returns of let's say a treasury bill. How does each of these funds behave, right? So it bundles the concept of risk, reward, and the risk-free rate, and gives us a view of which fund is better than the other, right? So let's say that the Sharpe ratio for the fund comes out to be 0.29. So what this means is that the fund will generate 0.29 units of return for every unit of risk that I'm undertaking. So naturally, I will expect like higher numbers. So the higher the ratio, Therefore, I'm saying that more returns is what I'm going to get for every unit of risk I'm undertaking. Okay, so what you'll see here, so I've put together like the Sharpe ratio, the beta and the alpha here, right? Standard deviation is something that you can also get from the fact sheet. Um, Typically, I'll go for the 5 year, because a 5 year of all these ratios, because that gives me a good, decent period of time to evaluate. Because otherwise, there will be years where, as you might have seen earlier, right, there are years where it got like 40%, 60% return, and suddenly you get like -1% return. So I picked like a median of 5 years to compare the overall performance of the fund, right, for these ratios. So the Saudi companies equity fund and the Saudi freestyle equity fund had a Sharpe ratio of close to 0.9 and 1.1, which is good, right? Which is a good Sharpe ratio. Above 1 is good. The beta, which is an indicator of the riskiness of how risky it is, as relative risk it is based on the benchmark, it should be on the lower side. So going less than 1 was a good factor. And the alpha factor is the extra return that you're getting compared to the benchmark, risk adjusted. That's also on the higher side, right? 7% and 12% for the alpha, for the first two. I just ranked them based on a weighted comparison of all these three factors and some other factors. So it's going in that order of Saudi companies equity fund and the Saudi freestyle. Factor in the GCC funds. I consider them as separate, because it's part of a separate category, right, where you're also getting international exposure if you're a Saudi expat citizen, right? I just created this kind of like a info card or a mutual fund info card, right? So just to summarize all the elements, so some general description about the Saudi equity income fund. We covered the expenses, we covered the portfolio mix, we covered the the technical parameters, and we also covered the historical performance, individual yearly performances, as well as the 5 year, 10 year, and since inception, right? So this gives me like a decent view of each of the mutual funds, right? So based on all this and all these parameters that we discussed, I did like a quick ranking for them. It's not, you don't have to blindly follow this as it is. I wanted to first explain the rationale, which is what I covered so far, and secondly, then based on that rationale, how do the funds perform. However, if you're someone who is an expert in the financial sector of Saudi Arabia, and you have good information and good analysis of the financial sector, you might directly go for the financial institutions, for the financial equity fund or the financial institutions equity fund, which is over indexed on the banking sector and the other financing sectors. Maybe if you're an expert in the industrial sector, you might go for this, or for the construction sector, you might go for this, right? So also factor in what you know about the industry, or if you're someone like me who is not particularly an expert in any one specific industry, and you want to have like a diversified mix, then preferably you might go for one of these three, right, which gave like a good return. The expense ratio has been on the lower side, the Sharpe ratio, the alpha, beta, all those parameters have been on the positive side as we wanted, and also had like a good diversified portfolio across sectors and across individual stocks, right? So this is my current ranking. Again, just to note, you should factor in these three separately, because they have a mix of UAE, Kuwait, and Saudi Arabia, right? So you cannot compare this to the rest. Similarly, you cannot compare like the thematic, the sectoral based funds also to the top first three, right? Because they're sector specific, and if you have an interest, right? So this was my overall ranking. So is this the right time to invest, or will I invest? I will not personally invest at this point in time. I want to invest, but not at this point in time. And therefore, I will preferably maybe wait for a couple of these months, because if you look into the NAV charts of all these mutual funds, they are in their all-time highs. Okay, because most of these are dependent on banks, and banks have been on making the most profits in this in the last two cycles. Because of the repo rate cycle is on the higher side, they are giving loans on a higher interest rate. They're making lots of money there, right? So funds which are dependent on banks or have a decent exposure to banks are all in their all-time highs at the moment, right? So for me, I will like to wait for a few months, at least till end of this year, and just see how the NAVs or the overall trend has been going on. Once it starts declining, I might prefer to enter, but at this point in time, if this 5,000 Riyal subscription is like 50% of your salary or 40% of your salary, that's a huge investment, and I preferably would stay out for a while and preferably enter this at a later point in time. So I'm not personally investing at the moment. I'm more invested in the MT30 MT30 ETF, which I was talking about earlier. However, if your fund manager is, let's say, the SNB or alrajhi, will have other options, and they have lower subscription fees, so you can go through that. If you want me to cover one of those fund houses, let me know in the comment section, and I'll take a look into them as well. Hope you like this video. So hope this channel was useful and a new insight to you. Please do share this with your friends, colleagues, and help me grow further.